Hi everybody, this is AJ speaking. This is part 15 of my Tesla 4Q 2024 financial review. We continue on. Here we look at Tesla's cash balance. So cash balance includes, I put here a note down here, cash and cash equivalents, restricted cash and short-term investments. So this is all the liquid cash-like instruments on Tesla's balance sheet. That's from an analytical perspective, that's the correct way of looking at Tesla's cash balance. When you want to look more holistically at Tesla's liquidity, which goes beyond just cash, which also includes Tesla's available credit facilities, you also would have to add 5 billion of unused credit facility that Tesla has. But in reality, Tesla has actually access to more cash than that even. So more than that even. What I mean is Tesla's cash balance plus the 5 billion in unused credit facility, plus there are certain local working credit facilities. For example, in China, Tesla has a large working capital credit facility, which actually pushes Tesla's total liquidity well above 40 billion and approaching almost 45 billion. So Tesla is super liquid. Tesla has absolutely zero capital need for anything really, because these are enormous amounts, so that there won't be any capital raise needed anytime soon. And Tesla could could easily spend 10 billion from that cash pile if they wanted, and they would still be, by automotive standards globally, would still be well capitalized. So Tesla's balance sheet is really, I mean, you could almost say bulletproof. If there's like a global recession, etc., if one comes out through it relatively well, this will be Tesla. So this is a very strong feature of Tesla. And when we look at the number, thanks to Tesla's positive free cash flow, that with few exceptions, it keeps growing. Except here, 1Q, we talked about it, there were some negative one-off effects, and quickly this negative change was more than offset by significant positive cash flow in the next quarter, and Tesla's cash flow balance just keeps growing. With that, we move on to Tesla's global charging network. The reason why I want to cover this in this financial review is because there was a lot of noise in 2Q when Tesla cut most of the Supercharger team. There was a lot of misreporting, as you can see in this trend. Tesla had, before the 2Q cut, volatility in how many sites they would open for various reasons. And you can see there was an increase to almost touching 400 sites in a single quarter. It came down to 270, moved up to almost 320, 330, 360, went down to just under 300, and then we had the cut in the Supercharger team in 2Q, came down to 220. So you see some impact here, but it's not like a complete wipeout as many people made it out to be. And Tesla basically kept growing sequentially and increased the number of sites added, and for the global network reaching almost 7,000 sites now. So despite the massive headcount reduction and getting rid of the head of the team, there was no material impact. And you also have to keep in mind the network has become quite good already. It's not perfect, of course not, but it makes sense to perhaps slightly adjust to market demand, the build out. And I'm sorry, I left here December expected. This should be obviously reported. But the big picture is this is still healthily growing, and this still makes Tesla by far the #1 global leader in fast charging. And when you look at these sites, you also have to consider these are fast charging stalls. These are not like slow chargers. And on that metric, there's nobody, not even half the size of Tesla. And then when we look at so what does this mean in fast charging, in terms of fast charging connectors? So Tesla has now over 65,000 fast charging connectors, and Tesla added in the fourth quarter just over 3,000 additional connectors to the network, and that meant that the average number of connectors per site added in the quarter was just over 11 connectors. And when you look at this time series here, the blue colors, you can see this is near all-time high, and you can see a trend towards larger sites, which also makes sense. And because for various reasons they make economically more sense if you really build for large scale future adoption. And so this is also very positive, and this is also a feature of Tesla's network that sets it apart from other networks, which often have awfully small number of connectors, which then sets up users for disappointment, because let's say you have just 3 connectors, one is broken, as is often the case, and then 2 are occupied by some vehicles, and then if you're unlucky, by slow charging vehicles, and you might wait for a long time, which makes for a very bad user experience. And that sort of thing is extremely rare, and it's just a consequence of the mathematics. One, Tesla has very high uptime, so there's very few stalls are out of order. Plus, there's such a large number of stalls that even if you have like very high usage of the charges, because people come and go, it's often a situation that that one becomes available just as you arrive, so you barely ever wait meaningful amount of time at the supercharger. That is a clear strength of Tesla. And this strength keeps growing quite quickly. And then here the final metric on this chart, we see how the global average across all stalls, regardless of period, develops. So Tesla's global average number of connectors per site keeps increasing, because Tesla tends to add larger sites compared to the past. And that's why the global average is already at almost 9.4 connectors per site. So that's quite strong. Then we come to the last topic I wanted to cover in this 4Q and 2024 financial review. And this is Tesla's warranty reserve. This is just what I would call let's kick the tires item. You can see that Tesla's warranty reserve. So first of all, what is it? Tesla, just like every other automaker, provides vehicle warranty, but also warranty for energy products. And there's some number of vehicles which will have a warranty claim, and to provision for that event, Tesla sets aside some amount of money. This is what everybody does. It's complete standard accounting practice. And in Tesla's case, because the fleet keeps growing, it's a new fleet, this warranty reserve just keeps growing quarter over quarter. It's completely normal, what you would expect. So on this chart, you see the warranty balance on the balance sheet, which has reached 6.7 billion as of December 2024. And then you can see in red what amount of warranty claims was incurred. So what did Tesla spend on warranty? And as you would expect, because the fleet is growing, this number should go up, and this is what you see. Tesla spent 405 million on warranty claims, and then in green you see what Tesla adds to the warranty provision, and this number also, because the fleet keeps growing, you would expect this number to grow, and this is exactly also what you see. And basically the net balance between the incurred cost plus the addition is basically what's driving the a Q&Q change. There are a few other items that are not that relevant, but net what you see is basically a permanent increase in the warranty reserve. And the warranty reserve, as I pointed out earlier in the cash flow discussion, the current portion, so what Tesla expects to recognize over typically the next 4 quarters, is part of payables in the cash flow statement, and this provides a what I would call a long-term positive cash flow driver in Tesla's case. And the reason why it's a positive cash flow driver is the quarterly provision is taken out of the P&L income, so it lowers the net income. But because it's not a day one cash out, it's being reversed in the cash flow statement, and that's why it's reported as a positive cash effect in the cash flow statement, as it should be. And that's why it's accretive, or it's positive for the operating cash flow. And so this is a continuation of the warranty reserve analysis, and on this slide we look at it in terms of warranty reserve ratio. And here on the right hand side you see how it's being calculated. You have the P&L warranty provision that we looked at before, the green number, and you divide it by the revenue with significant warranty. And what that means, when you look at Tesla's income statement, you have various revenue streams, but there are some revenue streams that do not have a warranty provisioning. For example, the automotive credit sales. It's a revenue item, but of course there's no warranty attached to that. So you should to do for proper calculation, you should remove all these revenue streams that do not carry a warranty, so you get to an accurate number. And a good way to look at it is in terms of quarterly reserving, provisioning, and also on a trailing 12 month, because there can be fluctuations. So it's good to look at both trends. And in Tesla's case, we have seen a long-term upward trend. So Tesla keeps provisioning more and more as a percent of revenue. So one negative interpretation would be, oh, Tesla has a little confidence in the reliability of its product. No, I don't think so. And the reason why I don't think so is you can see that there's a quite stable progression in the quarterly cost incurred. If there was something aggressive going on in terms of provisioning, we would see spikes here. And a very good recent example is Lucid. Lucid under provisioned its warranty reserve, and for that reason it had to take, relative to its scale, which is tiny, a huge extra provision, which then led to a huge spike in what you see here in the green number. So Lucid saw that the red number moved up, and because this indicates that in the future it will be higher, they then took an increase in the provision in the green number, so that you saw a spike. So if you run the same chart here on Lucid, you will see a spike in the green number, which was anticipation of future spikes in the red number here. And but in Tesla's case, it's clearly not the case. So Tesla just chose to prudently increase the reserve. This could be, but this is significant conjecture. This could be that Tesla is. I say this with maybe 30% confidence. So to take this with a huge grain of salt. This could be a slight preparation in Tesla taking the hit of upgrading hardware 3 vehicles of people that bought the FSD package to the latest hardware, and this could be some preparation of this. But again, I say this with a little confidence, because I think ultimately the way Tesla rolls, once Tesla hits autonomy, these one-off items will just disappear in the numbers, because they're not going to be needle movers at this point. And then this is another look at the warranty reserve in a more, I think, intuitive manner. It shows it also on a quarterly and trailing 12 months basis, but on a per vehicle basis. This warranty reserve is slightly overstated, because Tesla doesn't give us the warranty reserve split into automotive and energy. Hence, whatever warranty reserve Tesla creates in the energy business, which I expect to be relatively low, because it's it's a stationary product, and not like a mobile product like cars, etc., exposed to a lot of stresses, etc. I think it's very low, and but still something to point out. So this will be slightly overstated. I expect only a tiny overstatement, but bottom line is it's not exactly right, and so that's why I call it indicative here. But you can see that the warranty provision per vehicle keeps increasing. Previously I showed this chart also on inflation adjusted basis, but the trend is not too much different. Bottom line is that Tesla is reserving more per vehicle. That's the key takeaway. But we see on the quarterly basis, here in red, it refers here to the light turquoise color. We saw a peak in 2Q 2024, which makes sense. This was a very good quarter for Tesla, and it makes sense to take advantage of very strong quarters to bump up the reserve a little bit, and then Tesla started to take it down slightly. If I was Tesla CFO, I would do exactly the same things to give myself a little bit more leeway, more optionality. So, and with that, we are at the end of my quite long 15-part series on Tesla's 4Q 2024 financial results. I hope you took some useful insights away from this analysis. And then we get to sort of my favorite slide. One thing to always keep in mind when it comes to Tesla, and here I'm referring to Tesla stock. Always when people write off Tesla, Tesla not going to do anything. Tesla has an uncanny ability to pull what I call white rabbits out of the hat and to surprise everybody, and the stock takes off. So my recommendation is never write off Tesla, even though the financials near term might not be looking great. Objectively, just looking at the quarter 4Q 2025 was objectively not a great quarter, but evaluation of a stock is always forward looking. It's useful to look at historical financials. That's why I look at them, but it's for me mostly I kick the tires item to make sure everything is in order, and what I can see everything is in order, because I not only look at Tesla's financials, I also look at globally all the competitors, and I can see they're hurting enormously. They're selling large volumes of vehicles at losses just to keep their factories busy, and they're trying to copy as quickly as possible Tesla. You just need to look at some of the Chinese products, which are basically one-to-one carbon copies of the Model Y, and because the Chinese supply chain is also quite leaky, a lot of design features of the new Model Y made it, interestingly enough, into some vehicles of competitors before the new Model Y was released. Some people would say, "Oh, AJ, you're just cover for Tesla." No, I have. Anyways, I'm not going to dive into detail, but bottom line is Tesla is obviously, because it's the number one seller in China. People forget that. Tesla is the prime copy target of other Chinese companies, so that is why there's this huge industrial espionage going on, and it's no secret. And the espionage not only goes to Tesla, but obviously Tesla suppliers. So anyways, long story short, the financials didn't look good in 4Q, but as I predicted, the market looked past Tesla's current financial performance and looks to Tesla's autonomy and AI product robotics future. So with that, see you hopefully in my 2025 forecast, which I hope to produce soon. Take care. Bye.